Hey Royal Investors! Thanks for visiting our channel. We make new weekly animated videos about popular topics on finance and investing. If you'd like to see more videos, don't forget to subscribe. Before I start the video, I just want to say that this video is intended for beginners who have little to no experience in trading. So many people have been debating whether the stock market or the real estate market is better. If you're unsure about the pros and cons of each market, well, today we'll present our view to you so you can have a better understanding of both sides, how they work and how they compare to each other. Before we start, I just want to say three things. First, you should never invest based on anyone else's opinions. You should only invest in things that you understand. You should always have a plan when investing. Those are the three rules of investment that we follow closely. So I hope all of you that are watching understand that and take our video as a chance to broaden your knowledge. There's one saying from a wise investor and a business magnate that caught my attention. The quote says, "If you want to make money, go to places that have abundance of wealth." The quote simply means that you are more likely to be successful in making money if you go to places or industries with lots of wealth. So how do we find wealth? I'll start off with one of the articles from Forbes. This list shows the number of billionaires in the world, and the list says that 15% or 267 of richest billionaires in the world made their money in finance and investment industry, whereas only 9% of 163 billionaires made their fortune from real estate. If we were to take a look in the United States, 24% of billionaires made their fortune from finance and investment, whereas only 7% made their fortune from real estate. Therefore, in simple terms, it means that you are 3.4 times more likely to be financially successful if you are in the finance and investment sector than you are in the real estate sector. I'm not saying that the real estate sector is bad or anything. I'm just implying that if your goal is to be as financially well off as possible, then finance and investment is a better bet for you. But this does not take into account the work-life balance, learning curve, and complexity of both markets. So in order to have a reasonable comparison, I will base it on these 8 attributes below. So they are capital, gains or returns, value, liquidity, passive or active, tax bracket, fees, and diversification. So statistics aside, let's start off with capital. You need money to make money. That is true for almost every investment. If you are a new investor or are looking to start investing, you might not have a lot of capital. Capital is the most important part when deciding which investments to go with. In the stock market, you can start with almost any money that you have in your bank account. However, if you are currently in debt right now, I recommend you to pay off your debt before you start investing, because like any other investments, investing in stock market can make great returns but also has risk. Let's say you have $100, you can start investing in penny stocks. So that's anything under $5, or small to medium cap stocks such as Microsoft, Gopro, AT&T, Wells Fargo, Bank of America, and the list goes on and on. With $500, you can invest in almost any stocks, ETFs, mutual funds, forex, options, and future. So some of the examples are Apple, Facebook, Walmart, Home Depot, and etc. With $1,000, you can invest in large cap stocks such as Amazon, Google, Tesla, and others. The point is that no matter how much you have, you can start investing in stocks. But with real estate, you can't buy any real estate for under $1,000. Even if you do put down a 20% down payment for an apartment or a single family home, you're going to be stuck with it for the next 20 to 30 years. And this is not including the capital that you need to save for emergency funds if the toilet is broken or roof collapsing. Fixing it up are expensive. However, if you want to learn how to invest in real estate investment trust with $100 or less, you can watch our video where we talk about REIT. So the next one is gains or returns. When we're talking about gains in the stock market, we're talking about huge gains. Depending on how risky you want to be, you can get anywhere from 50 to 100% year-on-year return. Or you could just be conservative and invest in an index which gives you 10% each year. I can give you a big list of stocks that has greater than 20% year-on-year return last year, even when the S&P 500 that tracks an index wasn't even doing that well. For example, if you bought a stock last year at $100, 20% on your return means that your stock is worth $120 this year. Well, how about real estate? According to an NYC real estate market report by Curb, the average sales price for Brooklyn homes were over $788,000, and price per square foot has increased 7% on all sales in New York City. Well, if you live in Brooklyn and have 20% of $788,000, which is $150,000, and 20 to 30 years of time to pay off the mortgage loan, then real estate is for you. But if not, then real estate might not be your thing. How about cheaper house, you ask? Well, homes away from big cities are certainly more affordable, but when it comes to return on your money, it actually shows slower growth compared to homes in big cities. So the next attribute is liquidity. Liquidity is another important factor to consider when it comes to your investment decision. If you put $1,000 today in the stock market, can you pull out the next month after the value rises by 15%? You can take out money anytime you want to cash out the $150 profit. Because of this flexibility, it allows investors to put in or take out any amount they wish at any time. All you have to do is to click a single button to sell your positions. Stock market is perfect for investors who are looking to put their money in a stock that gives good return but may want to have access to capital in the short term. However, in the real estate market, let's say you put 20% down payment and lock in the house for 20 years. If the economy goes bust within the next 5 to 10 years, what are you going to do with the house? Well, when the house market tanks, the prices go down and no one wants to buy it unless you sell it for 30 to 50% off of the price that you bought it for. Or you may have to wait until the market recovers to sell. But the market takes time to recover. After the 2008 subprime crisis, some homes in Detroit area are still selling less than their value today as they have to pay for repairs, unpaid taxes, liens, water bills, and etc. The same goes for buying a house. You need a few months to find a good deal, do inspection, and get the mortgage loans. Everything could take 3 to 6 months before you could finally occupy the house or rent it out. The next attribute is the exact value. When investing in stock market, you know the numbers in your head to plan for your investment strategy. How much the current price of Apple stock, how much dividends they are paying, and how often they give you. These are all noted into the exact dollars and cents and the date. And how many percent is the dividend yield, and when can you use the yield to buy other investment. This just shows that you can better plan and manage your finance for the future. However, with investing in real estate, you can't determine the exact price for a home. You have to search for the recent sale of homes in your neighborhood and approximate the value from there. Or you can go to an appraiser and hope that they do a good job for you. The same for rental income. You could say the rental income for a month is $2,400. But when no one is renting your rooms, there's nothing you could do but lower the rent because less income is better than no income. So you rent it for $1,800, which is $600 less than your initial expected income. That's not including the vacancy, which could negatively impact your annual rental income. Next attribute is passive or active investment. So why many investors choose to go with investing in the stock market? It's because you can make the same or more returns with less effort compared to real estate. You can be 18 years old or 65 years old and still invest in the stock market because it takes very little to start investing in the stock market. You can do it in your spare time, as a part-time, or even a full-time day trader. The possibility is limitless. But with real estate, it takes a lot of time to find good deals, do inspection, going to different banks or agencies to get the lowest rate for mortgage loans and fixing it up. After that, you have to go through the hassle of finding a buyer or tenants and constantly be afraid that the tenants might not pay you or damage your property. The next attribute is tax bracket. The tax bracket is important for investors because investors want to keep most of what they have earned. Rental income is taxed at ordinary income, which is 27 to 30% of tax bracket. But in the stock market, the dividends that you earn from your investment is taxed at a lower rate, which is 15%. So if you have $10,000 annual rental income, you might need to pay $3,000 in taxes. If you put it in the stock market that gives you $10,000 a year in annual dividend, you only need to pay $1,500 in taxes. The next attribute is the fees. Fees are fairly important because investing in real estate automatically signs you up for realtor fees, management fees, emergency funds, fees for fixing broken stuff. You might also need to pay property taxes, insurance, maintenance, and interest payments. For a stock market, you only have to pay commission fees to your broker if you trade by yourself, or any management fees if you are in the mutual funds. The last attribute is diversification. In the diversification column, unless you have tons of money for you to invest in different cities and countries, there's no way for you to diversify in real estate. You might be able to buy office, warehouse, or house in your city. But if the local economy is not growing, you are just betting at different things in the same pool. When the pool dries up, your assets are exposed. For stock market, you can diversify into any industry that you like. You can invest in technology, commodities, financial institution, automotive, and etc. Again, the possibilities are endless. Or you could just put your investment into a fund that tracks the 500 biggest company in the States and diversify your portfolio. Now you know how the stock market works and how it compares to the real estate market. If you'd like to see the other side of the argument on how real estate is better than stock market, don't forget to comment down below. And as always, plan your strategy carefully before you make any decisions, and I hope you have success in whatever investment that you pursue. If you're interested in supporting our channel, don't forget to check out the Audible link down below where you can get any audiobook for free, and if you don't like the audiobook or the service, you can cancel it before the trial subscription ends and still keep the audiobook for free and also help benefit this channel. And if you just came across this channel, you may want to subscribe because we make weekly animated videos about popular topics on finance and investing. So comment down below your thoughts, and if you have any interesting topics that you would like us to cover, put it down below as well. Thanks for watching.